So those are some of the themes we're watching out for. Give us a sense of what you're looking at as well for the year ahead.
Yeah, I think that's pretty much accurate in terms of what to expect. I think the other thing that I would add to that is that we are going to see a lot more withdrawal of stimulus. The central bank liquidity is going to get withdrawn. That's been a big driver of the market. So there's a lot of cash still sitting on the sidelines. We think that's going to drive the market up probably until the end of January. And then things are going to get very rocky, we think, after that, especially into the second quarter.
No, that takes us to the balance sheet question, Mo. And you guys put out a note for your clients, as I guess to look at the first few months, not so much the whole year. I mean, who knows where we'll be 6 months from now. But what you guys are saying, the balance sheet will play a lesser part, if you will, a smaller correlation to equities. Can you just explain that for us?
Yeah, so basically, over the last 13 years, the balance sheet expansion has been the biggest explanatory factor of what's been happening in equities. And certainly since March of 2020, we've seen a 97% correlation. Now, it's not that the balance sheet is not going to play a role. What's going to happen is that the balance sheet is pretty much going to stop expanding from probably the second quarter. And what we're seeing is that the market is already pricing in a lot of that balance sheet expansion already. So somewhere around the 4,888 region, I think I've talked about previously as well, that's where we factor in all the liquidity for 2022. And so what we're recommending is if we go above that level, we could overshoot to as much as 5,200 maybe on the S&P in the next few weeks. And if we manage to do that, then anything above 4,888 is where you actually want to start distributing all the holdings that you built up in the second quarter of 2020.
And Mo, okay, we talk about the Fed. We've got Joe Biden's administration likely to appoint 3 more members here. That's going to be fairly crucial looking ahead. And then LIBOR is being consigned to the waste bin of history too. How do those two relate, and how does a more hawkish Fed at the moment play out in the markets, or is it all priced in now?
Well, I don't think it is completely priced in yet. I think there's certainly more hawkish members of the Fed that are going to be voting this year. But then Mr. Biden has also got another 3 members that he's going to be appointing to the Fed. So it's going to be quite an interesting debate as to what comes out. And we'll hear later this week the minutes of the December meeting and the expectations for rate hikes. So I think at the moment what we have is the market still moving according to this tapering, accelerated tapering. I think that's been priced in, but I don't think that rate hikes, and certainly not excessive rate hikes, have actually been factored in by the market. My view is actually a lot more dovish than the market on inflation, especially towards the end of the year. But I think that's going to be the chances of more rate hikes than the market is thinking about is probably going to be one of the key concerns for the middle of the year.
You guys see the dollar index topping 100. Mo, that probably can't be good for at least non-U.S. equities.
No, I mean, I'm not bullish on emerging market equities yet. I was just looking again at China tech shares, still not bullish on that. I think there could be a 4 or 5% more rally in those in January. But again, there's still concerns around them. And certainly if the dollar goes up in the way that we expect it to do on the back of rate differentials, then that's certainly not going to be positive for emerging markets in general and Hong Kong equities in particular. So really no change in view. The fact that it's January the 1st really doesn't make any difference in terms of the longer term trends.
But what if inflation moderates from here, even slightly? Because we might be seeing some signs that base effects might kick in. China PPI prices, for example, have started to come off a little bit. I mean, how does that view on the dollar, sort of jive with the view on inflation?
Well, this is one of the reasons why we're not as concerned, but let's say as other people on inflation. Certainly, a stronger dollar will help in terms of keeping those inflation pressures lower. The base effects will wash out, and I think what we have to look at is not spot commodity prices, but actually looking down the futures curve and looking at what's going to be inflation, oil prices, for example, towards the end of the year. So yes, inflation is elevated, but again, we think that a lot of these are going to be washing out, and certainly if we're towards the end of this COVID episode, then as markets and the economy normalizes, then a lot of those inflationary pressures should wash out, especially towards the end of the year. My view is perhaps we might be talking about disinflation again by the end of 2022.